some of the dollar amounts that have been tied to some of these social media companies. $52 billion for Facebook, Twitter, $9 billion, Groupon also in there at $6 billion. Are they all really worth these big numbers? Our next guest says there's a bubble, and it may burst. We're joined by Eric Jackson, CEO and co-founder of CapLinked, also author of The PayPal Wars, a member of the so-called PayPal Mafia. So, Eric, really a bubble, and when is it going to burst?
That's really the billion-dollar question, isn't it, Margaret? Valuations have certainly increased. Valuations have soared in the last year. A study by NYPEX LLC that came out in December suggested that valuations on secondary markets had gone up 53% in just 6 months. So valuations are getting very high. I don't know if we're due for an immediate bursting, though. Unlike 1999, these are actually good companies with revenue and good business models. It's not like we're looking at a bunch of Pets.com, Webvans, and Flues type of companies that have no idea how they're going to monetize.
Right, but it's a matter of faith, right? That you just said the revenues are good and whatnot. They're private. We don't get a whole lot of information about the companies. That's why the valuations are somewhat of a guessing game, people would say. Do you think some of these secondary markets need to increase disclosure?
Well, I'm not sure if it's disclosure as much as it is volume. There's only about $5 billion annually that's traded on these secondary markets. At least that's the figure that I've heard. And that's really not a lot when you think about the market cap for these companies. So there's a good chance that the valuations are just being driven up on perfectly good companies because there's a lot of retail investor demand. And when you look at it, that same study, by the way, from NYPEX suggested that retail investors are paying a 31% premium over what institutional investors are paying. So it's not a question of the companies being bad. It's just a question that the valuation on secondary markets might be a little bit high because there's so much demand for these companies and they're not going public.
Eric, let's talk specifically about Facebook and Twitter. Of course, as you know, Margaret was just in Cairo, and that revolution obviously had Facebook and Twitter at the center. And I asked a digital media banker yesterday, I said, are the valuations out of control? He said, just look at that as an example of the power of Facebook, and that's only going to make the valuation even bigger. What do you think of that?
Well, it definitely is a revolutionary product. It's amazing to talk about Facebook, a company with over a $500 million users. But, you know, I think the question about the valuation, tying back to that, is why isn't Facebook a publicly traded company yet? I mean, this is a company with over $2 billion in annual revenues. They're very profitable. If they were at least traded on the market, we'd have greater transparency and we'd have a better idea of what they're really worth. And I think the answer to that is it's become so onerous and expensive to be a publicly traded company. So many great companies like LinkedIn, Zynga, Facebook, Twitter, they've delayed it as long as they can. There's no rush to have an IPO like there was back in the late 90s, in part because the regulatory compliance is so high.
Is it also simply a matter of, and I understand your point about Sarbanes-Oxley and what is it, the $2 million in compliance costs and whatnot that it adds to your bottom line, or deducts from your bottom line, I should say. But isn't there really something maybe inherently about tech companies that behooves them to stay private? I mean, if they want to experiment with new businesses that are capital intensive and not have to answer to investors. I mean, is there something also in just the willingness of private equity to participate in here that doesn't force companies to go public to raise capital?
Well, that's actually a great point, Margaret, and things have changed a lot in the last decade. Founders are capable of getting much more friendly terms these days, so they can get some liquidity early on. They'll be allowed to take some equity off the table, so it puts a lot less pressure on the insiders to rush to being public. And on the whole, I don't think that's a bad thing. So there certainly is less of an incentive to rush to IPO. But the question is, once a company has become really valuable and has really grown their business model and proven that they're a real business, why aren't they going public? And I think there's just pent-up demand on the part of retail investors to get a piece of the action when it comes to LinkedIn, Facebook, or Twitter, or one of these other great social media companies.
Eric, if there is a bubble in these companies, then do the companies themselves see that? And if they do, then what are they going to do next?
Well, I'm sure that none of them are going to publicly admit to that if they felt their stock was overvalued. I mean, I think right now it's a really good time in tech to do acquisitions. So you're definitely seeing some of that. You're seeing the likes of Facebook and Twitter make talent acquisitions where they'll go out and buy good companies. Google, for example, a few months ago bought Slide, which was started by a former PayPal colleague and co-founder of PayPal, Max Levchin. So I think there's these instances where they'll go out and they'll buy companies that have a really good team in place.